Hi everyone. Stocks dipped lower, although investors tried really hard to defend the January highs. Optimism turned sour due to expectations of new aggressive rate hikes by the Fed. The regulator is strongly committed to reining in inflation. This is why investors have to revise their predictions. Last week, there were no significant changes on Wall Street. However, the main U.S. stock indices fell lower, approaching critical levels. Stock indices broke out of the sideways range amid a batch of macro stats published recently. The Dow, the S&P 500 and the NASDAQ declined to their support levels where the January rally started. Traders wonder what to expect next. Will the bulls be able to regain their upper hand, or bears will keep pushing indices lower? The new week started on a relatively positive note. However, a slight increase on Monday could hardly be called a rally. Watch our video review till the end and find out more interesting details. Leave your comment down below. Let's start. Given the current trajectory of stocks, short selling continues despite the fact that investors have already priced in all the economic and political events. Wall Street needs bearish factors to drop lower. This week, speculators are looking forward to the speeches of Fed policymakers and the release of US ISM index. Perhaps the new comments and economic data will dispel the last doubts about a long-term monetary tightening. Soaring inflation remains the main market-driving factor. Traders were discouraged by another stronger-than-expected inflation report. The Personal Consumption Expenditure Price Index, the Fed's preferred gauge of inflation, accelerated to 4.7% in January versus the forecast reading of 4.3%. A new surge in inflation means that the regulator will have to take an extra effort to cool the economy. Besides, another report showed that consumer spending rose sharply in January on the back of steady wage growth. It also indicates that a policy reversal looks unlikely in the near future. Investors also want to make sure that commodity prices have finally stabilized. Now, consumer prices are rising solidly amid an overheated labor market with the lowest unemployment rate in the last half-century and the recovery of the service sector. This is why the Fed needs to cool down the economy. This is the only way to cap inflation. In other words, the central bank will create conditions for lowering consumer demand and triggering a drop in new jobs. Fed policymakers still believe that a soft landing is possible. However, there is just an assumption, not a fact. In the past, the Fed was unable to engineer a soft landing. At some point, it may become difficult to control the fall in markets. There are almost no bullish drivers for stocks. They have already slid significantly, notching the worst weekly performance since the start of December last year. The Dow Jones extended its fourth consecutive losing streak, tumbling by almost 3%. It is extremely disappointing since the indicator tried to break out of the bearish channel and consolidated in the sideways range for almost a month. Bulls seemed to have full control of the 34,000 level. However, they had to give up amid stronger bearish pressure. As a result, it lost to 1,000 over the week. Stocks also dipped due to weak earnings reports. A pessimistic profit forecast from leading retailers Walmart and Home Depot led to a drop in the shares of both companies by more than 3%. Walmart's stock managed to recover while Home Depot's shares took a nosedive. In any case, the companies unveiled downbeat forecasts for the near future. Naturally, this also contributed to the downtrend in the market. At first glance, it appears that stocks are in a downward spiral again, and they could approach new lows due to the Fed's hawkish stance. However, traders priced in all these bearish factors a long time ago. They do not rule out the likelihood of a 50 basis point rate at the March meeting. In the worst case scenario, the key rate may reach 6%. Risk of sentiment may only intensify amid new fears, especially about the economic prospects. If not, the further downward potential is likely to be limited. In this case, stocks may consolidate at the current levels or start a correction. The S&P 500 ended last week with losses of 2.7%, logging the worst weekly performance since December 9. The indicator dropped below 4,000, signaling a chance of the worst-case scenario, with stocks shedding 25% in the first half of the year. This outlook was revealed by Morgan Stanley. If so, the S&P may hit 3,000 level. The Fed is not going to end monetary tightening. It is expected to keep the key rate at a restrictive level for a longer period. Traders will have to accept it, or no matter how hard they want the opposite scenario. A steep drop looks imminent, but analysts predict recovery in the second half of the year. Nevertheless, the S&P 500 will hardly be able to fully recoup its losses until the end of the year. Morgan Stanley estimates that the index will end 2023 at 3,900. Some analysts are not so pessimistic. They suppose that this rollback is temporary and soon the index will grow sharply. Time will show. The S&P 500 is now deep in the downward range. Volatility is likely to increase. Trading in the medium term will take place in a wide range. In the short term, the index may consolidate in the support area of 3,980, 3,930. If the index settles at this level, the rebound scenario may actually come true. After that, the asset could test the resistance level of 4,310. This is also the correction level logged in the fall of 2022. This is a rather strong resistance level. Bulls will have to try really hard to push the price above it. At the same time, a drop below 3,880 will signal a false bullish breakout. In this case, the index may tumble to the support level of 3,760. The heavy tech NASDAQ 100 also closed in the red, extending a second week losing streak. Its losses amounted to 3.3%. Prospects for the new week are grim as well. The NASDAQ is correcting downwards, sliding below 11,700. It signals a strong bearish bias. It may eventually fall to the range of the fourth quarter of last year. After breaking through 11,550, which happened last week, the sellers are aiming at 11,250. However, some investors remain optimistic despite the current dismal picture. They suppose that the NASDAQ could return to the support level of 11,910. If so, the rollback may indeed be temporary. After that, a steady increase to 12,850 is possible. If this scenario comes true, the index may test 13,175 before returning to the high of last summer, located at 13,600. If we carefully analyze the fundamental and the technical indicators, we can see that the market is somewhat oversold. It has reached a strong technical support level from which stocks may rebound in the near future. The earnings season is almost over. The results turned out to be better than expected. The majority of companies managed to increase profits despite the current headwinds, namely aggressive rate hikes and high inflation. Almost 85% of companies included in the S&P index have already unveiled their earnings reports. About 68% of them have exceeded profit forecasts. Revenue figures for the fourth quarter are slightly less positive. Only 65% of companies beat analysts' expectations. Apart from disappointing reports from several large companies, the results are quite upbeat. Now, Palo, Alto Networks and Arista Networks shares look extremely attractive. They have a huge upward potential after the recently published strong indicators. Since the start of the year, the shares of Palo Alto Networks have soared by 34%, while Arista Networks stocks rose by 12%. The first firm is a leading company in the field of cybersecurity. The second one develops and sells routers and other network equipment for cloud providers and large data centers. Wall Street analysts gave their companies a buy rating. Palo Alto Networks has a growth potential of 9%, while Arista Networks shares are likely to rise by 23% from current levels. That is all for now. Hit the subscribe button and stay up to date with the latest market news. See you!